Hello, everybody, and welcome to our Thursday morning webinar. Our guest today is Guy Nicio from Wines Accounting. Today's topic is opportunity zone investing, where we're lucky to have Guy with us as our expert speaker. Guy specializes in focuses on tax planning and consulting for mid-sized and small businesses, as well as tax compliance for corporations, partnerships, and individuals. He has extensive experience working with closely held businesses, pass-through entities, and their owners, and he possesses technical expertise and knowledge in the areas of federal multi-state income taxes for businesses and individuals. Guy, thanks so much for joining us. Appreciate you taking time. How are things going?
Oh, going great, actually. Fortunately, we have the technology to be working from home, and we have that flexibility, so it's going great. And thank you for having me today. Appreciate the warm welcome.
Yeah, no, it's topical conversation with opportunity zones. I know there's been lots of rules and regulations and laws, and I think why don't we just kind of start with it? With any new tax law, there's often kind of more questions than answers. And maybe if we start from the top, maybe share with us a little bit of how, opportunity zones came about and what the initial, incentive for private investors was all about.
Sure, absolutely. So it all started back in 2018 with the Tax Cuts and Job Act, when there was a pretty substantial law change for tax purposes in many areas. And as part of that, they had the opportunity zone legislation, which effectively was intended to bring investment to economically disadvantaged areas across the country. And in order to incentivize the public to invest in these areas, they offered some pretty robust tax benefits. So it was a pretty lengthy legislative process, but ultimately they ended up with over 8,700 qualifying economic zones across the country. And those are basically handled at the state and local levels in terms of which areas were going to be qualified based on some applications that were submitted to the federal government. So now we have all these zones and a lot of people like yourselves and Pintar who put together some funds to take advantage of the opportunity for the investors and to bring improvement to the cities where they were looking for that.
Yeah, one of the questions I'm often asked is, how are these zones determined and created? And is it a set number? Is there a chance or risk of them going away or even, new areas being, allocated into the zones?
Sure. So, I mean, it's a set number now. Basically, the process, the federal government came out with some basic criteria that had to do with income and per capita and different criteria that made it display that they were economically disadvantaged. And the local governments were responsible to basically apply for the right to be a qualified zone. And there was a deadline to submit their application. So those cities and regions that did so, if they met the qualifications and they submitted the application on time, the federal government approved that, and those are set and permanent. So there is really no, absent further legislation, there's no opportunity for additional approved locations or for the ones that would currently exist to go away.
So as of now, the 8,700 plus or minus, those are the zones we're dealing with. They're all easily discoverable through variable websites, but those are the zones where these opportunities exist for private investors with capital gains to make investments in.
Absolutely. And the one comment I'll add to that is that it's sometimes, I guess, a misnomer that they all look like rundown areas. For the most part, they're economically disadvantaged, but there are surprisingly some areas that one would not think would qualify as a zone. So we've learned not to make the presumption that they're not in a zone if they look like they're nicer areas, because sometimes based on the way the criteria and statistics fall out, certain areas are zones. So we look to the experts who are formulating the funds and making investments and have their advisors behind them to check the zones that qualify and rely on that rather than making any assumptions.
One of the assumptions too, just along that, and not to get too far down this rabbit hole, but I think it's interesting and just part of the Q&A. But one of the questions that I get from fairly sophisticated investors, but maybe they just haven't had the chance to dive in deep into the opportunity zones and the rules and the regs of it all, is, are there any mandates of what you are supposed to build in an opportunity zone? A lot of people view it as, to your point, as, oh, it's a really sort of rundown area, and the money has to be invested in low-income housing or government housing or something of that nature. Are there any such restrictions?
So not within the opportunity zone law itself. I mean, obviously any particular location may have their own local laws that are not connected with the opportunity zone that have such mandates, but specific to the federal opportunity zone laws that came out with the Tax Cuts and Job Act, there really are none. It's just qualifying property that's located within the borders of the designated opportunity zones. And the key is, what's the definition of qualifying property? And that is, in most cases, for your typical investor, it's real estate. It's real property. And I don't want to get too much into the weeds on that, but it's real property that has to meet certain other requirements. If it's raw land, then obviously you have to build on top of it. And if it's something that's pre-existing, you have to substantially improve that. But really, that's more the concern of someone like yourself as the fund manager, to make sure that you're meeting all those criteria. And obviously you have your legal and your accounting advisors to help you make those tests. But from the investor standpoint, they don't really have any need to worry about.
Yeah. So as a guy like us, we're going by a property. We're just really following, as long as it sits within one of those designated opportunity zones, and we develop to whatever that zoning is. It could be an office building, it could be student housing, it could be an industrial building, it could be residential apartment complex, it could be a movie theater. As long as it's zoned and entitled within that opportunity zone, you're in compliance. You're not restricted, I guess.
You know what? One thing just came to mind. Pardon the omission of this particular fact, but there are a few types of businesses, because sometimes qualifying property can be what's known as an opportunity zone business. So if you actually choose to go the route of an opportunity zone business, an operating company, rather than just building a building,
Okay.
for example,
Yep.
there are certain types of businesses called sin businesses, which are not allowed. And those are things like bars and casinos and spas and so on, country clubs. So they're not allowed to have those types of businesses, but absent that, everything else does qualify.
Got it. Excellent. Well, one of the things let me just backtrack a little bit for all the audience. This is meant to be, free flowing, and on your screen, there's a chance for you to ask questions along the way. So if something pops into your brain, and you have a question, please click on the Q&A button and just type in your question. That'll pop up on my screen, and we'll do our best to cover it. But to kind of start off, and I think that's a great background, Guy, let's just run through a real life example. Let's say I've got $1 million gain that happened in 2019. Is it too late for me to invest that gain into an opportunity zone fund now and take advantage of some of these tax benefits we've heard about?
So not necessarily. It really all depends on the facts and circumstances, and that's where it gets a little bit muddy. So it's not too late to invest if you had a gain in 2019, but you really have to look at the time frame that's transpired between, like, when in 2019, for example. It's possible that it was an earlier 2019. That time is up. So everyone, I think, is familiar with the 180-day rule. That's the most fundamental rule of the time period that you have from the date of the sale to invest in an opportunity zone fund in order to qualify. But the 180-day rule comes with a few variations that really complicate things a little bit.
Okay.
So
leave it to the tax laws, right?
Yeah, well, and then COVID-19, of course, complicated things further to the benefit of the potential investor, since it gave people more time. If your 180 days was going to be expired within a certain time frame, then it's going to be extended to July 15th, similar to some of the income taxes. But let's just start with the basics, and then we'll kind of delve into where it changes. So the basics is it's 180 days from the date of the sale. So
So the
think of
date
that.
of, when you say of the sale, of the realized gain, so, and the gain can come from any variety of things, right? I could sell an old classic car. I can sell my Apple stock my grandma gave me, 20 years ago. I can sell, or I was in a partnership in a property that sold. Is that
Sure,
what you
or
mean
even the
by sell?
business.
Or even a
Yes, it is.
business,
Right.
right?
Absolutely. Absolutely. The key is that it has to be a capital asset and the resulting gain has to be capital gain. So those rules are all the same for whether with or without opportunity zone law. But if it's a capital gain from the sale of a capital asset, then that is the eligible type of gain. So those ordinary income assets, for example, will not qualify.
Okay. So here's a question that came up. What if I sold my company to another company 5 years ago, and part of that was an earnout, and my earnout expired at the end of 2019, and I had a bunch of unrestricted stock that is now, I can sell it. Um, am I allowed to take those investments from the sale of my unrestricted stock, and that stock's quadrupled in that time frame, and use that as a capital? Is that treated as a capital gain, or would that be a non-capital gain investment?
So as long as you're, so stock, yeah, the sale of stock would be capital gain, absolutely. So,
Okay.
and if the recognition date of that sale is post enactment date, so in 2019, for example, then it would be eligible for reinvestment and for the tax benefits of opportunity zone.
Okay. Okay. Great. Great. All right. So basically, what you're saying is, if the gain happened, is it within 180 days of the end of December or the end of 2019? I could still use that money to invest in an opportunity zone fund.
So it depends on whether you're an individual with,
Okay.
or, so let's start with individuals. So if you're an individual without being involved in an entity, then the answer, that is not the answer. In other words, if you're just an individual who owns a capital asset and you sell it, say on October 1st, well, of 2019, you have to
Okay.
count one. Now it's, unfortunately, it's not easy to know all the dates, because if to say 6 months is not accurate, it actually has to be 180 days on the calendar. So you look at the calendar and count how many days in this month and that month, and it doesn't end up being exactly 6 months in pretty much all the cases. So you have to just look at the calendar and count 180 days from the date of the sale if you're an individual. Now, if you're in October, I don't know off the top of my head without counting, I don't know what that math is, but there's 31 days in October, 30 in November, 31 in December, and so whatever gets you to 180, that's the deadline to reinvest into an opportunity zone fund. However, if you're, so under the new COVID era rules, with the IRS extending all tax deadlines that were originally due on April 15th, there's a specific provision in there for opportunity zones and even 1031 exchanges for that matter. If your deadline of the 180 days falls between February 15th and July 14th, it's extended, you have until July 15th.
Okay.
Right? So if your 180th day lands in that range between February 15 and July 14, you just ignore those days and your new deadline is July 15.
It gets pushed out. It got pushed
Yes.
out. You got an additional 60 days.
Well, you have until the exact date, July 15th.
Got it.
So it's not
Yeah.
60 days, wherever
Not
you're.
60. Oh, got
Yes,
it.
exactly. So
Okay.
that's the first rule for individuals. Where it's different, when what you're talking about counting from the end of the year, and that's actually changed in the final regulations. It's if you're a partner in a partnership, or say a shareholder in an S corporation, a pass-through entity, right? So if that entity sold an asset and that entity itself, the partnership or the S corporation, is sitting on a capital gain, the entity has the option to reinvest the proceeds into an opportunity zone fund and take advantage of these benefits as at the entity level. So in other words, the individual partners don't have that decision making, but whoever's managing that entity, they can decide to reinvest. But if they elect not to do so, then since the partners didn't have the opportunity to do it when the entity was deciding, or the shareholders, now they get to start counting their 180 days on the due date of the tax return, excluding extensions. So for example, for a calendar year-end partnership, that would normally be due on March 15th. So for all of the partners, their 180 days would start on March 15th of the subsequent year. So if you had the 2019 sale, March 15th, 2020 would be when they start counting their 180 days.
Okay.
And I think I did the calendar count on there, and it takes you to September 11th. So basically,
Okay.
all partnership, all tax return owners, whether it be through a partnership or an S corporation, that are calendar year end, their due date to invest is September 11th, 2020.
Okay. And so that's under the assumption of a gain that was that happened in 2019. What if I had a gain in 2020? I mean, here we are in May. People have had gains, this year. Does that same 180 days apply for gains made in 2020?
It does, yes. And the same rule applies for both individual investors as well as partners and shareholders of S corporations. So those who are, so if it's in 2020, if you're an individual, you just count 180 days from date of the recognition date of the capital gain transaction.
Got it.
And if you're a partner or a shareholder in an S corp, then you have the option to start counting on the due date of the tax return next year, which would be March 15th, 2021, would be day one.
Day one. And there's been some discussion back and forth on the benefits of investing in the opportunity zone, and there's two different components, right? There's actually three. You got the reduction of the capital gains tax that you would owe. You got the deferral of it, and there was something to do with, you could get 10% discount of the capital gains, or maybe 15%. How does all that work?
Yeah, so when the law was originally written, on the date that it was written, you had the opportunity to get as much as or up to 15% permanent forgiveness of your original gain. But it's a little bit different now, because when I say up to 15%, it happened in two timelines. If you hold the investment in the fund for at least 5 years, you get a 10% forgiveness, if you will. Tax accountants like to call it a step up in basis of 10%, but it equates to being forgiven permanently. And I'll remind everyone that this is federal only, and states are on a state-by-state basis, but California does not comply. But if you hold your investment in the fund for 5 years, then you will get 10% forgiven of your original gain. In other words, you never have to pay the tax related to 10% of your original gain. Now, if you had held it for 7 years, then it would have been an additional 5%. That's how it gets to the 15%. The problem is there's a piece that we haven't talked about yet, and this is a deferral, right? And the deferral only lasts until December 31st, 2026. So 12/31/2026 is the legislative, that's the date where you have to recognize the gain that you originally deferred.
What was that date again?
December 31, 2026.
Okay.
Okay. So as long as something else didn't happen first, like someone sold out of their interest, as long as somebody's money's still in the fund on that date, everyone has to recognize and report the gain on their 2026 tax return. So they would have originally paid it, potentially in 2020 for a 2019 sale, but now they got another 7 years effectively to pay the tax.
Okay.
But except for either 10 or 15% of that original amount. Now, if you haven't invested already, it's too late to get to 15%. And the reason is you need to have your money in there 7 years by the time we get to 12/31/2026.
Got it.
And that expired on 12/31/19, because now you can only get to 6 years and X days.
Okay.
By that date. So that's the difference. So now it's 10%. If you're not already invested, if you had your money in by the end of 2019 and you're still in on 2026, you get 15% forgiven, period. If you start now as 2020 and forward, the most you can get forgiven is 10%.
And is that, so let's say I have a gain in 2021 and I want to invest that into an opportunity zone fund. Is it still 10%, or is it a decreasing?
It's 10%. There's only two possibilities. It's either 10% Well, I guess we'll call it 3. You're either going to get 15%, 10%, or 0.
And in what instance would it be 0?
If you invested after December 31st, 2021,
2021.
and
So
before
if I have a
12/31,
gain in, so
2026.
if I have a gain in 2022, I sell a company or I sell my Apple stock or whatever in 2022, I could still invest those gains into an opportunity zone and get the advantage of the stepped up basis. And
The 10-year stepped up basis, which we haven't spoken about yet.
right. So okay, all right. So maybe we'll talk about that as we get to that. So in this instance, so back to my $1 million gain that I got in 2019, or we can even call it 2020, because all I can get is a 10% discount on my cap gains tax rate that I would have owed. When do I have to pay those taxes?
So you have to report them on your 2026 tax return.
2026 tax return.
Yeah, making sure I understood your question correctly. If you
So I
invested
made $1 million in 2019. I'm investing that into Opportunity Zone Fund. When do I have to pay those taxes on that $1 million?
So if that's the original capital gain that you invested in Qualified Opportunity Zone Fund, you pay the taxes on it no later than, we'll call it April 15th, 2027. In other words, the due date of your 2026 tax return.
So I get 7 years. I get 7 years of use of my capital before I have to pay taxes on it.
Yes, or 6.5 if you want to be
6.5 right now. Yeah. and so the next question that comes to mind is the tax rate on that gain. Is it the tax rate of what it'll be in 2026 or April of 2027, or is it the tax rate of what it is today? Because many people believe taxes are going to go up, right? It's not. If I was a betting man, I'd bet there's a better chance of taxes increasing in the future than decreasing. And so if I don't have to pay my taxes on this $1 million until April of 2027, is it at the tax rate in April 2027, or is it at today's tax rate?
27. It's definitely not today's tax rate. It's the tax rate at the time of the recognition in 2027.
Okay.
Well, I guess 2026 is the better way to say it. 27 is when you pay it. 2026 is the tax year rates that would be in effect.
Got it. So that's, at least I get 10% off and I get the deferral of it for that time frame.
Correct. Absolutely. And then, of course, we haven't talked about the bigger benefit, which we'll get to, I'm sure.
Yeah. So let's say, so I got a question too before that, because this comes up. So, 2026 is still far down the road. I got my $1 million, my gain. I decided to go invest it in, say Pintar Opportunity Zone Fund or somebody else's. It puts me in safe haven. I'm in compliance. I don't have to pay my taxes this year. What happens in, say, 2024 or 2025, sometime before those taxes are due, that I end up taking my money back out? Are there any penalties that I'm faced with? Do I have to pay the taxes, at that time I take it back out? What happens in that instance?
So there are no penalties to the investor, but you potentially have to pay the taxes because it's what's considered an inclusion event. So basically, there are a number of inclusion events that are listed in the final regulations, and that's one of them. Basically, if you liquidate your equity interest in an Opportunity Zone Fund in one way, shape, or form, you can count that that's going to be a taxable event or an inclusion event in this case. And now you have to report whatever the current status of your gain is. And I say whatever the current status is because remember, if it was in there for 5 years, you got a 10% step up. So 2024 is, 2024, you're right on the cusp that you could have had 5 years in And so now you only would be reporting potentially 90% of your gain as long as you had the full 5 years of the investment holding. Now, the reason also why I say potentially is because depending on what the gain is. So if it's just you coming out, if it's just an investor coming out of the fund, whether it be by their choice or because the fund decertified, it's an inclusion event and you have to report that gain on your tax return. You can't, there's no way to defer it any longer. Okay. However, if there was new gain generated by the fund, let's say they sold an underlying asset and that generated more capital gain, well, the partners can make an election on that new gain as long as you're not past the 2026 when the law is still available to you. And so that would start a new holding period, so in other words, if you wouldn't have a chance to get to the 15% since here we are past the end of 2019, but as long as you do it before the end of 2021, you still couldn't get the 10%. So it would be a new election, another deferral, but that's for new sales of underlying assets by a fund. If you're just liquidating your position, you just report it and you pay the tax.
Okay, so that brings up, I think, takes us to the biggest benefit, I think, for investors is the full stepped up basis you get if you keep your money in the fund, invested in Opportunity Zone Fund for 10 years. Tell us about that.
Yeah, that's the big one. And that's the one that has, the big picture thinkers really excited because it's kind of an unprecedented tax opportunity for investors. And it basically says that if you continue to hold the investment of qualifying money in an Opportunity Zone Fund for 10 years, at that point, you may elect to, at the point where you sell it after the 10 years, you can make an election to step up the basis to the fair market value, effectively meaning you're not going to pay any tax on any of the appreciation post-investment. So if you put your $1 million in today and held it for 10 years and 20 years down the road, it's worth $5 million, you don't pay tax on the $4 million increase in value federally. You would still pay potentially state tax, but for federal tax purposes, you will not pay any tax on that appreciation.
No federal. And so, I mean, that there is the largest driving component of this new tax law. I believe it's allowing investors to grow their capital essentially tax-free. And you would think in most instances, because of the laws around the redevelopment need or the development need in order to be compliant, you'll have significant depreciation benefits, which should offset the majority, if not all of the income you're receiving along the way. And so tell me about depreciation recapture. In a normal investment, if you were to depreciate against income along the way, you'd have a recapture of that depreciation at the time of sell. Is that the same for Opportunity Zone funds?
No, so it's that's a big advantage for this particular law is that it includes the step up of any prior taking depreciation. So you truly step it up to the gross amount of the value of the asset. So there is no recognition of gain, even for the depreciation recapture piece. So big advantage.
So my $1 million, let's say my $1 million makes a 7% cash on cash through this investment along the way. That's essentially an after-tax 7%, because if I can offset it with all the depreciation, and then in your example, let's say the $1 million grows to 5, I don't pay any taxes on that 4 million gain, and I'm essentially not paying any taxes on the income along the way either. Is that accurate?
Correct. If your example is saying that your depreciation was enough to shelter the income, then yes.
Correct. Okay. Then here's maybe a sticky question. So let's say I invest in Pintar fund, and I'm in there for 5 years, and it doesn't grow to 5 million, but let's say it grows to say 3 million. I then take my money out, and so I take, I invested 1, but now I get 3. Can I reinvest that into another Opportunity Zone fund and keep it in there for another 7 years. So my money's been invested in an opportunity zone fund. Maybe it's not the same opportunity zone fund, but it's been invested in opportunity zone funds for the full 10 years. Do I still get the same benefits? And then that, say that 3 million grows to 6 million. Do I get
No.
you can't, it doesn't work that way?
No, you don't get to add them together. So you'd start over basically every time.
Start over with the new 10 years.
Yes, and the opportunity to invest in a fund with that advantage will expire at the end of 2026, which is the same as the deferral date. So in other words, you can't start over in 2027. It's too late by that point. So it's all got to happen before the end of 2026 for any new investment into an OZ fund.
So for those sitting on gains, so if I have a gain in 2027 or 2028, I won't be able to invest those gains in an opportunity zone fund?
Correct.
So if you're running a business or you've got a business plan on a project that's got a business plan of, realizing whatever potential gains you have past that date, you'd really be smart to be thinking about bringing that date forward to invest that capital into an opportunity zone fund to take advantage of, all the stepped up basis.
Sure, absolutely. For tax purposes, yes. And obviously there are other strategies that I could not speak to, but for as far as taking advantage of the incentives available under the opportunity zone, the answer to that is yes, absolutely.
Got it. So just back to my example, and maybe I'll ask the question. I'm probably asking it same. I want to probably ask the same question, maybe a different way. Is so I invest in, say, Pintar fund. I grow my million to 3 million, and that's in the first 3 years. So say 2023, and then in 2023, I invested in your opportunity zone fund. Do I have to keep it in your opportunity zone fund until 2033? To achieve the same benefit of the stepped up basis?
I guess I lost the fact pattern there. It's 10 years. So
it's 10 years from my initial investment?
No, from in any opportunity zone fund. You don't get to add them together. So if someone invests into my fund, and I don't remember the year that you said, 2023?
2023.
Yes, so you're right. 10 years later would be 2033. So that's absolutely correct. It'd be 10 years in my fund, that example.
And you can continue to sort of play that, I guess, kicking the can down the road up until 2026. Is that right?
Yes, but I want to be careful that I'm understanding the facts correctly, because remember, I tried to go over this example earlier on one of your prior questions. So you can't just come out of a fund and then take the same money without new gain and go into another fund and can kick the can down the road, as you say. That's an inclusion event, and you have to report the income if you come out of your fund. It's the only time you can go into a new fund is if you have a new capital gain. In other words, another sale. So if they have a sale of a building within your fund generates a gain, which is passed through to the investors on a K1, for example.
Got it.
Well, they can elect to invest that gain into my fund, but they can't take the original gain out of yours and then pop it into mine and then keep doing that. It becomes an inclusion event as soon as they liquidate out of your fund, if it's the original investment proceeds.
Yeah, okay, and that makes sense. So they have to report that and do it. I think that makes a lot of sense.
By the way, there's one comment that I think is worth sharing, even though you didn't ask the specific question, because some people might think 10 years is a long time, depending on how old they are, for example, and they might think, well, I don't really want to live 10 years in today's day and age, if they're already 110, for example. But it's important to know that the heirs of anyone who's an investor get to step into the shoes of the decedent, basically. So if someone dies, it is not an inclusion event that automatically becomes taxable. So if they're at year 9 and then there's a death, for example, well, whoever the beneficiaries are of that heir, they get to step into the shoes of the person who died and continue on with the investment benefits and the tax benefits. So they can hold it for that additional year to get to 10, and then they won't have an inclusion event. So I just wanted to share that in case that's come across anyone's mind.
Yeah, that's a great point, especially, as people are, planning trusts and, estate planning and things of that nature. I think that's an important point. One of the questions we had that just came in from the audience uh, is there any special treatment today for gains at the state level in California, or are they payable at ordinary levels, assuming kind of the timelines that you just specified?
So, if I'm understanding you correctly, the answer is no. California has zero compliance with opportunity zone tax laws and incentives. So there's really, it's for California purposes, it's as if the law does not exist. So whatever gain that you had, you're going to report it on your tax return and pay it like you would if there was no opportunity zone law. It's not, this federal legislation does not impact California at all.
Are there any states that where there is an income state tax, like Nevada or Texas or something like that, obviously, or Florida, where there's zero income state tax? It wouldn't matter anyways, but are there any states where there is income, state level income tax that is also, recognizing the same benefits for, at the federal level?
So I knew we were going to get to the point where you would eventually stump me. So the answer to your question is yes, but I couldn't tell you which states are which, because there are a lot and they all have their laws, and they haven't necessarily. I've heard New York is one, but obviously we're located in California, and so I know California laws most. I can probably find a resource that has a list on a state by state basis and send one over to you, and maybe if anyone's interested in seeing that material, post call, then you can distribute it that accordingly. But I don't have that off the top of my head.
Okay. And here's a question. I probably know the answer, but I've got to ask it, just as we're talking about the state level taxes. So I live in California. In my example, I got my $1 million gain. I invested into a fund. I don't have to pay those taxes until my 2026 tax return. What if I move to Nevada between now and then? And I've been in Nevada for a year. It's got zero state income tax. Is my California tax owed? Then does it go away?
So I think we're mixing up a few rules here. Remember, California is not going to allow you any kind of deferral.
Okay, so I'm going to have to pay my California taxes the year.
Correct. Yeah.
Okay.
So it doesn't matter if you move because you've already paid your tax.
Okay. All right. Well, see, I had to ask. I got all kinds of crazy questions that,
No, they're understood. There's so many moving parts to this thing, but I appreciate the question.
What did I say? I said earlier, sometimes with these tax laws, there's more questions than there are answers. So
Indeed.
What do we? I think we're nearing the end. I don't have any other questions on my list, but what are some of the things that you're being asked from some of your clients that could be addressed that we haven't already challenged you with?
So there's been a few questions along the way. Some of it I think we've talked a little bit about, but one that we haven't talked about was, well, what if I want to gift the ownership interest in the qualified opportunity zone fund to my child, for example? What are the implications of that? And
okay.
The answer to that question, that's one of the inclusion events. So it's not necessarily a good idea because that would be treated the same as if you liquidated your position without gifting it. So now all of a sudden taxes is going to be recognized in that situation.
Okay.
I think I'd say that the most questions that we get have to do with the timeline, because it's as much as it's, if you write it down step by step, it's really not that technical. But there's so many particular rules for when to start counting the 180 days. If there was some confusion over 1231 gains for a while until they clarified that at one point you had to wait till the end of the year to net out all the different 1231 gains that might have gains or losses before you can start counting, and they eliminated that rule. And now it's just date of the sale. If it's recognized, then you look on at that asset alone, and you don't worry about what other sale transactions you might have. So they've
Okay.
clarified that in the final regulations. But a lot of the questions come really from the fund owners, fund management side in terms of how long do I have to deploy the capital that my investors have put into the fund to build this thing out. And there have been a lot of, I guess, changes in that area that have become helpful and useful for fund managers and given more time, really, especially with this COVID situation and federally declared disaster areas, allowing additional couple years to spend the money. So originally it was a safe harbor of the 31 months to spend the capital that you have from your investors on acquiring and developing the property. Well, now with the federally declared disaster area, you have an additional up to 24 more months on top of that original 31 months. And then if there are government delays to applications that have been submitted beyond that, you basically get a pause on those time periods. So there's really a lot of leeway for fund managers to make sure they're able to complete projects that they have taken on if there are delays for things like COVID-19.
Sure, certainly. And I think that's a really good, an important part of it as well. I mean, just because you have the money, and if there's a clock ticking to invest it, otherwise, all the investors are going to have to get their money back, and then they're going to have to pay the taxes. To not have that clock ticking and force people to make bad decisions, I think is really, really important. And that kind of leads me to, one of the questions that I have too along those lines is let's say we're not able to find any suitable investments, after the 50 months comes up and we're like, man, we can only invest half the money we raised, and we just don't see that there's good deals to invest in, and we return the other half of it. Is there penalties to the investor in that event if that money is not invested and just returned to them, or is it just simply they then have to pay their taxes at that time frame?
It's the latter. They simply have to pay their taxes. It's an inclusion event, and there's no penalties to the investor. Any penalties that would be imposed with regard to the opportunity zone really happen at the fund level. So if you don't meet the 90% test, which is basically saying that 90% of your assets, excluding any reasonable working capital, have to be in qualifying business property, also excluding the working capital safe harbor that we just discussed. But if you don't meet that 90% test, then there's a penalty that's charged to the fund for every month that you're not in compliance, but not to the actual investor.
Got it. And I'll end the questions with what I think is probably a softball, but it's often the most important. So I got my gain and I'm doing my taxes. How do I let the government know that I've invested in some opportunity zone fund and I'm not going to pay my taxes on the $1 million gain I just had?
Yeah, so your tax preparer should hopefully know this. If they don't, they need to be familiar with it. There's a new form that's filed as part of your personal tax return if you're an individual investor that reports it, and that's Form 8996. Let's make sure I didn't get that form number wrong. 8997. I was off by one. IRS Form 8997 is part of the tax return. So as long as the right boxes are checked, you have to file that within the initial year of your investment and every year with your tax return until you liquidate the investment in the fund. So
okay, so that form gets completed each year, and it's basically letting the IRS know, hey, look, I put my money into an opportunity zone fund, and it's still in there. It's still in there. And then
yes.
when 2026 comes around, you got to pay.
Yes.
Yeah. Not a bad deal, though. Not a bad deal at all.
Not at all. I mean, it's a big opportunity for those who are in the right fact pattern.
Yes, that's right. Hey, well, listen, I really appreciate you taking the time, and I know this is new law, new rules and regulations that are coming up, and there's lots of questions, create more questions and answers, but as we live with this a lot longer, we'll all get more informed. But the clock's ticking for those that have a 2019 gain. depending on when the time of that gain was, to make this election as they're getting ready to file their taxes. So I appreciate you taking the time to educate, a lot of our clients as well as yours that have dialed in today. And we'll circulate this. This is being recorded, and we'll put it up on our YouTube channel for people. Obviously, if we can get your guys' compliance approval first, and people can reach out to you directly if they have any further questions. So thank you again for your time, and for the audience. Next week we're going to have an update on our main fund 3's sort of May productivity, and so please keep an eye out for that invite. And Guy, thanks again. It's always a pleasure, and thanks for all the good work you're doing.
The pleasure's been mine. Thank you for having me today. Appreciate it.
All right.